In recent days, investors worldwide have been eagerly anticipating a potential agreement on the U.S. debt ceiling, while markets continue to rise. Finally, it appears that a deal is within reach, bringing relief to investors and providing a positive boost to financial markets. However, not everything is rosy for market gains as concerns arise from recent economic data coming out of the United States. The Personal Consumption Expenditures (PCE) Index, a key measure of inflation, exceeded expectations, registering a 0.4% increase compared to the previously estimated 0.3%. This data has raised concerns about inflation, as it may indicate higher than expected price pressures on goods and services. An acceleration in inflation could lead to higher interest rates and potentially pose risks to long-term economic growth. In addition to inflation, new orders have seen a decline compared to the previous quarter, suggesting a potential contraction in economic activity. This decrease in new orders could be attributed to several factors, including slowing domestic and international demand, supply chain issues, and uncertainty surrounding trade policies. These concerns about the state of the economy may impact investor confidence and undermine the overall economic recovery. Furthermore, estimates for Q2 GDP in the United States have undergone a drastic downward revision, dropping from an initial projection of 2.9% to 1.9%. This significant revision may be attributed to various factors, including recent financial market volatility, political uncertainty, and fears of weaker than expected economic growth. Such a revision could have a negative impact on investor confidence and influence market performance. Meanwhile, two major central banks have made decisions regarding their interest rate policies. The People's Bank of China has decided to maintain its interest rate unchanged, signaling a stance of economic stability. On the other hand, the Reserve Bank of New Zealand has raised interest rates by 25 basis points to 5.5%. This move has had a significant impact on the New Zealand dollar, which experienced a sharp decline. However, the New Zealand Central Bank has also announced the possibility of a rate cut in the next meeting, introducing further uncertainty and volatility in currency markets. Apart from the developments in the United States, Europe is also facing its own economic challenges. The latest data indicates a decline in the Purchasing Managers' Index, PMI, which measures economic activity, in several European countries, including Germany. Particularly, the PMI for the services sector, which had shown strength in previous months, has exhibited signs of slowing down. This slowdown could be attributed to a combination of factors such as rising commodity prices, supply shortages, and pandemic-related restrictions. In the United Kingdom, inflation has begun to decrease from 10% to 8.7%, but it remains above expectations. Such a level of inflation may exert pressure on the Bank of England, BoE, to increase interest rates in order to curb inflation. This move could have implications for economic prospects in the British financial markets.